Welcome to the InterMarket Analysis video update. This is a video that I do once a week where I not only look at other indexes in the stock market, because most of the focus is on the S&P 500. We look at the small caps, we look at the Dow, we look at different sectors in the stock market, but I also look outside of the stock market at some other markets because sometimes that can give us some clues as to what is happening. We're seeing a general shift right now, and some of our charts are starting to switch from either negative over into positive or positive into negative as we enter into 2024 and try to figure out the path going forward. Sometimes looking at all of these different charts, we're able to get some insight that we would not get any other way. This is being prepared for Monday, January 8th. The first area that we look at is S&P 500 valuation. Is the market considered to be expensive, fairly priced, or inexpensive? And we look at this a couple of different ways. The first way is to look back based on earnings that have already been reported and then comparing those to the current price of the S&P. Another way is to look forward based on analyst projections and forecasts to see, okay, going forward from here, what does the market think will happen as far as earnings are concerned? The first chart that we look at looks backwards, and this is called TTM, or trailing 12 months. What we do with this is we have static numbers, 10, 15, and 20. When you compare the past earnings with the current price and you get a score of 10 or under, the market is considered to be inexpensive. When you have a range from about 11 to 19, the market is considered to be fairly priced. When we're at 20 or above, the market is considered to be expensive. Well, looking at the black line at the top here, we're well above this red dashed line, which is the PE ratio of 20. So based on what's already happened as far as earnings, the market is considered to be expensive. Then on the bottom, I just have the difference between the two, the S&P 500 and the PE ratio of 20. When we're above zero, that means we're expensive. And that can be helpful to give us some ideas of what were the valuations over different periods of time. But the market doesn't use that. They like to look forward. And I have another chart to show you of that. We can also look at different historical events and what the valuations were at that time. There's another way of looking at previous earnings reports developed by Robert Shiller called CAPE, C-A-P-E, or the Shiller PE ratio. And this takes an average. And based on his calculation, we're currently coming up with a score of 31.78. To give us some context, we have a historical chart that we can look at. And then I also plot up here the median and the mean, where we're between 16 and 17 on a historical basis. Right now, we're getting a reading of 31.78. So according to this, the market is considered to be expensive. But this can go on for quite some time. It can go on for years. We don't necessarily use this to make decisions. We just want to know the overall situation of the market on a valuation basis. Here's the forward-looking PE ratio from Y charts. We're coming in at 21.66 for the S&P 500. That means that we're a little bit expensive based on their calculations. Here's another chart that I got from Isabel Net blog charts, where it takes the combined PE ratio, the trailing 12 months, the last 12 months, and then the forward PE ratio, and puts them together in one score. Right now, we're at a little bit above the +1 standard deviation. So when you take all of these together, we are looking a little bit expensive right now. This is the earnings per share growth that's being projected on a year-over-year basis as of January 5th. And the light blue areas, these are areas that have already been reported on. The dark blue areas are forecasts going forward and the consensus of what they think will happen. And for the most part, we see things as quite positive. We see growth going into 2024, a little bit of a fallback into the third quarter, and then another surge in earnings as we go into the fourth quarter of 2024. Now, these are just forecasts and projections. They might not necessarily be grounded in reality, but this is what the market uses. And if they see earnings growth going into the future, folks are more inclined to buy. They're not buying what the earnings are right now. They're buying what the earnings are supposed to be down the road, with the idea of buying a stock at a lower price and then selling it at a higher price at some point in the future. Then we also look at growth versus value, and this has been an area of concern since we hit the October lows. When growth is outperforming value, that's generally good for the market, and that's when we see the indexes really start to go up. When value is outperforming growth, that tends to mean that the market is anticipating some kind of problems or trouble, because these are companies that are more established. Folks may get into value type investments for the dividends or based on their current valuation, with the idea that maybe something is inexpensive now, and then at some point in the future, it will become expensive, and then that's when they decide to sell it. We look at just a peer growth index here, where we are in an uptrend, but you can see since the beginning of 2024, we've been really falling back with this index. We also look at the value index, which has recently generated a golden cross here. So we have both the growth and value indexes by themselves in uptrends. Where it becomes interesting is when we do ratios between the two. And for a lot of 2023, growth had been outperforming value. But you can see where we've been really starting to trail off here, specifically since about October. And that's a little bit of a concern. And I've been bringing this up in the different charts that I use in the daily videos, and I'm trying to keep a close eye on this, because this is not necessarily healthy. At some point, the market may have to reckon with this, and this may explain some of the weakness that we've been seeing at the beginning of 2024 when you combine that with profit taking and the huge run up that we saw to end 2023. We also look at a value to growth ratio, which is just an inverse of that same chart, showing how value has been underperforming but starting to bounce back. Now, the reason why I use a lot of different charts and different calculation methods is you can see that the moving average crossover here was offset by a few days. Because different indexes are calculated differently, they're weighted differently. We use ETFs, and they're all proprietary. They're all just a little bit different. That's why we look at a lot of different charts to try to come to an overall consensus. Here is an ETF of growth versus value, where we're still seeing the blue line on top of the red line, but it's really rolling over as growth has been underperforming value according to these ETFs. Here's an inverse of that same chart, showing how value is starting to show some strength when compared to growth. Then we look at another set of indexes showing how we're just getting ready to see a death cross here when we look at the growth to value ratio on this chart. And we're not quite there yet when we look at the value to growth ratio, but value has been outperforming lately. Then we look at some other indexes showing how growth has been in a longer term uptrend, but lately has been underperforming. Then some other ways of measuring this, where growth has been doing quite well lately, but you can see it's really starting to trail off as the market had been going up, and that's been producing a negative divergence. Here's looking at value, where we are seeing it bounce back up, even though it had been underperforming for a lot of 2023. Here's just looking at the small caps and looking at their growth to value ratio, where they've been chopping sideways more or less, but we have seen a recent death cross here when we look at this ratio. And we're seeing some weakness, where the small caps were supposed to be experiencing this thing called the January effect, and they did until we started 2024, and now the small caps are starting to fall back. Well, as the index was going up, we were going sideways with the growth to value ratio, which is a bit of a negative divergence. And then as we've been seeing weakness with the small caps, now we're seeing this ratio continue to go down. So this is a warning sign for us. And we're seeing a little bit of that as well with the mid caps, where the mid caps were going up with the index, and this was hanging in there. We were above the upper moving average here and in a pretty solid uptrend. But as we've been going down with the mid caps to start 2024, we're seeing this ratio also rolling over. Then this is the important one for what I do. This is S&P growth to value ratio. We're also seeing a negative divergence here. The S&P had really been going up. The growth to value ratio had been going down. And another couple of days, and we just might see a death cross here, where we actually see growth starting to underperform value. And that's a warning sign for us. We keep an eye on inflation, where the CRB index on the monthly chart, it's pretty much been going sideways. It's actually on the daily chart starting to shift over and go negative. On the bottom, we also have a monthly chart where we look at inflationary areas and do a ratio with deflationary areas, and we're below a declining moving average, meaning that inflation is not a real problem. We want to keep an eye on this, though, because deflation can also be a problem. And if this ratio keeps going down, it'll get to the point where it could actually be more harmful than beneficial. Here's the CRB index, where we're just seeing a death cross right now, where it had been up for a lot of 2023. Now it's starting to go back down. Here's the Baltic Dry Index. What does it cost to ship products from one place to another, specifically in the Baltics? It really spiked up as interest rates were going up. It's been coming back down, but it's still in a longer term uptrend. And I know there are folks that like to take this index and then switch it ahead 3.649 months and put it on top of the S&P 500. That's fine. I don't do that. I just look at what's happening right now. I don't necessarily do any shifting with the charts. Some other markets that we keep an eye on that we don't necessarily actively trade in or that we're involved in, but we just want to keep an eye on these anyway, where aluminum is still in a downtrend, even though it has been bouncing up. Corn continues to be in a downtrend. Wheat is also in a downtrend, but starting to bounce back up. Fertilizer has been declining in the shorter term lately. Oil's been bouncing all around. We saw this real spike up when things started to really go crazy in Israel. And then since that time, oil has then been coming back down. If geopolitical events happen, typically that can really have an impact on the price of oil. Gas continues to be in a downtrend. And then we look at diesel, which is also in a shorter term downtrend. It declined, started to go back up, and is now going back down. Heating oil continues to be in a longer term uptrend. It's really choppy right now. The blue line is still, well, it's just a little bit below the red line here. It's really hard to see, but we're just seeing a recent death cross with this. Natural gas, after really spiking up, came down, started to bounce back up, and is now going back down, and is in just a little bit of an uptrend now. Copper, which we look at because that gives us a barometer of the economy. When copper's going up, that tends to look better economically going forward. When copper's going down, that might suggest economic weakness. And we're just getting ready to see a golden cross here. But copper's been really choppy lately as the economy is trying to figure out, is it going to get stronger? Are we going to go into a recession? Are we going to just see a slowdown without going into a recession? And that's part of the debate that goes back and forth. And that's why we look at all these different charts. We also do a copper to gold ratio. When the economy's looking better, copper outperforms. When there's geopolitical uncertainty or sometimes economic weakness, that's when gold has a tendency to outperform. And lately, we've been chopping more or less sideways as copper has been starting to underperform gold. And here's a longer term look at that same chart. That's the black area is the ratio. And we also plot the 2-year yield and the 10-year yield on here, where yields for the most part have been coming down, even though to start 2023, yields have been going back up. But we're also seeing this ratio continue to decline. And there's still a really wide spread between the two. You can see other times in the recent past where they tended not to get all that far apart from each other, even though they're on different scales, and they had a tendency to move in the same general direction. They've actually been diverging from each other now for the past few years. Gold continues to be in an uptrend, but it's not necessarily breaking out yet. Silver is still in a downtrend, and it's pretty much chopping sideways. And then we look at the closing price for gold on top, and then in the middle is the closing price for silver, and on the bottom is the correlation between the two. And it only stands to reason that, okay, when gold goes up, copper or silver probably goes up too. When gold goes down, silver probably goes down too. And that's true for the most part. That's what this correlation reads along the bottom when it's giving us a very high reading. It did get out of line there for a while, but now it's starting to show a stronger relationship. Then we look at the gold to silver ratio on top, and sometimes we can compare that with the dollar index here in the middle area, but lately their relationship hasn't been all that strong with each other. Here's the dollar index, which continues to be in a longer term uptrend, even though as stocks were going up since October, the dollar's been going down, but it did bounce up just a little bit to start 2024. Here's the euro, which is now starting to see a golden cross, a golden cross when compared to the US dollar index. And the Japanese yen is still underperforming, even though it bounced back up lately. So here's an individual chart of the euro where we're just starting to see a golden cross here compared to the dollar. The Japanese yen has been bouncing back up, but it's still in a longer term downtrend. The British pound to the US dollar is also just getting ready to generate a golden cross. Then we look at some other indexes, and I show this in every daily video. We look at the S&P 500, which is a weighted index, so the big companies have more of an impact. And then we compare that with an equal weight index, where all stocks are treated the same. And we are seeing a bit of an improvement here, where when the red line is underneath the S&P index itself, that means it's underperforming. Now they're more closely matched with each other. Again, they are on different scales, though. And here's the ratio between the S&P 500 and the CRB index, which are commodities, showing that stocks are still outperforming commodities. Here's an inverse of that same chart, showing how commodities are underperforming stocks. And then we compare the NASDAQ 100 to the S&P 500, and they're both seeing a little bit of weakness as we go into 2024. This was a little bit of a concern. We're still keeping an eye on this. The S&P 100 is now starting to underperform the S&P 500. The S&P 100 are the biggest stocks that make up the S&P 500. And with the big stocks really leading the way in 2023, we're starting to see that go away when we look at the S&P 100. So is that a little bit of a concern? We're not really sure right now, but we are keeping an eye on this. But this has been going on now for quite some time and is a little bit of a concern. We look at a ratio between the NASDAQ and the S&P 500. Both have been under pressure at the beginning of 2024, but they're still in longer-term uptrends. The NASDAQ 100 is outperforming the NASDAQ, and even though we're seeing some weakness to start the year, the NASDAQ 100 has been holding up better. Here's the mega cap, the big magnificent 7 or the great 8 or the illustrious 11, however many you want to put in your group. And then we compare that on a ratio basis with the S&P 500 equal weight index, where the mega caps have been outperforming, but we're seeing this really start to drift off now, even though it's still in a longer term uptrend. We compare small caps with the S&P 500. That's the red line, which is this ratio. It was really going up as we were seeing the January effect. Now it's starting to go back down as small caps have been under some weakness. Here's another look at that ratio where it was really showing some improvement, even though it's in a longer term downtrend. Now that ratio is starting to come back down. And then this is another chart from Isabel Net blog charts. It just shows inflows into small caps in 10 of the last 11 weeks. And no wonder small caps are falling apart. This became the thing to do. And everybody was pretty much expecting small caps to have the January effect. So that's what we're seeing here. There's a lot of money going into this. Well, now we're starting to see some weakness. The market likes to defy what most investors end up trying to do. And the fact that we're seeing a real uptick in inflows is probably some of the reason why we're seeing some weakness in the small caps. Here are the biggest software companies. We're trying to get back to an uptrend here. We were looking a lot better at the end of 2023. Now we saw some weakness this past week. We're just barely starting to give a golden cross here. The mega caps still continue to hold up well, even though they fell back in the previous week. This is the robotics and AI ETF, which had been showing some improvement and now is seeing some weakness. We compare that on a ratio basis with the tech sector, showing how the AI ETF was doing better and now starting to fall back a bit. This is the Dow Jones Composite Average, which takes the Dow, the transports, and the utilities and puts them together. And we are seeing an improvement here, even though it's rolling over to start 2024. Recently, we did see a golden cross with this index. Then we compare the S&P 500 with shorter-term bonds. Even though we're rolling over recently, stocks are still outperforming short-term bonds. This is a broad market measure comparing further out bonds. It is rolling over, but still, when you take the bigger picture look, the stocks are outperforming bonds. This is the low volatility ETF, which is starting to go back up, and we're just not quite there, but it's almost ready to give us a golden cross. Then when we look at a ratio between the low volatility ETF and the S&P 500, it's been really underperforming for 2023. It's starting to bounce back up. We're wondering, is this going to keep going up, which might signal some concerns for the stock market. If this turns and starts to go back down, then that typically means that the market is going up. We look at the tech sector and compare it with 3 to 7 year bonds where it rolled over. It's a little hard to see with this box here, but it did come down in the latest week. But overall, it has been outperforming when you look at tech. Then we look at an advanced decline line study, and I show this in every daily video. This is NYSE common stock. Even though we're seeing a little bit of weakness, it turned up a bit because we had an update on Friday, but we're still above the advancing moving averages with all the indexes that we look at here. We also look at the S&P 500, the mid caps, and we're still seeing some weakness with the small caps. However, it's still above an advancing moving average. And then this is another concern that I've been harping on for a while now, where the Dow's been doing quite well, and it's actually breaking out above this previous high. It recently, not in 2024, but in 2023, was setting a series of all-time highs. Well, we didn't see a corresponding rise in the transports, and that's a negative divergence. When the transports are really doing well, that tends to give good support to stocks, and we're actually seeing them underperform. Utilities on the bottom, they tend to follow what interest rates are doing. And as interest rates were coming down, as stocks were going up, we saw utilities going down. Then lately, we've been seeing a little bit of a splurge in utilities as they've been going back up. And then in the past week, we did see interest rates go back up. This is a ratio between the transports and S&P 500. When this is going up, that means the transports are outperforming. And you can see that often supports the index, the S&P 500 index going higher. Lately, it's been really underperforming. And when we started to go up in October, this ratio continues to go down. That's a warning sign. Then we look at the Dow to transports ratio. When this is going up, that means the Dow's outperforming. When this is going down, that means the transports are outperforming. And we've been chopping more or less sideways for some time here, but then we saw a little bit of a spike up where the Dow was outperforming the transports. And then we look at the relationship between the two. We have the S&P on top and the transports in the middle, and they have a pretty strong correlated relationship, meaning they're going in the same direction at the same time. We want to see more strength from the transports and have them really go back up. That would give more support to the S&P to go up. Then we take a new look at Dow theory. Instead of using the Dow, some folks suggest, well, why not use the S&P 500? That's a better representation. And then on the bottom, instead of using the transports, because we're not a railroad society anymore, why not use the NASDAQ, which is mostly tech? And that's more indicative of the kind of culture we have now. And then plot that out. And we have been seeing a real nice move up with the S&P, even though it's been falling back lately. We're not really seeing any kind of divergences here. We did see some pressure under the NASDAQ over the last week to start the year, but nothing that's really out of line, at least yet. Then we look at the FANG index. This is Facebook, Amazon, Apple, Netflix, Google, and some other stocks. And even though they're pulling back after setting a series of all-time highs, we're still holding up. We're above the 50-day moving average, and we're still in a longer-term uptrend. This is a longer-term chart of the FANG index where we have been seeing some weakness. If we continue to fall, we'll be watching this red line here, which is a previous high. And if we continue to fall under that, we'll also be watching these other areas as potential support. ARC, which continues to be in an uptrend, it ended up being down on the week and has been under pressure lately. And then we look at the S&P 500 on a monthly chart. And just on top, you can see when we're above the red line, which is a moving average, that means we're positive. And then we do a ratio of international stocks that are based in Europe, Australia, Asia, and the Far East. And this shows that the S&P is outperforming. We also can look at this on a momentum basis, and we're above zero. This is the PPO that we use, but it's rolling over just a little bit. So that's a little bit of a concern, but it hasn't actually turned full-blown negative yet. But keep in mind, this is a monthly chart, so it takes a long time for this to update. Then we compare stocks with bonds. This is the total bond ETF, and we're seeing a real improvement in bond prices, enough to give us a golden cross here. But as interest rates are going up to start 2024, this ETF has been going back down. The Pring World Bond Index is showing a lot of improvement, but some recent weakness. However, it's still in a longer-term downtrend. Stocks continue to outperform bonds on the monthly chart. We saw a little bit of a turn down, but now it's starting to go back up. And on a shorter-term basis, bonds are underperforming stocks. Then we look at high-yield corporate bonds, which are junk bonds, and these continue to do quite well, even though they didn't start off the year with a lot of strength. They're still in a longer-term uptrend. Investment grade bonds are seeing some real improvement here as the price was going up, but lately they've been under pressure, but we did generate a recent golden cross. Then we compare riskier bonds with more conservative bonds, and the riskier bonds are holding up for right now. We're pretty much chopping sideways with this ratio. We do a stocks to bond correlation. When this is giving a high reading like it is now, that means that the price of stocks and the price of bonds are having a real strong tendency to go in the same direction at the same time. This is the corporate bond index, which just generated a recent golden cross, even though it's showing some weakness. And here's the 10-year yield after getting up to 5% has now been coming back down, but over the last week, it's been going back up. Here's a longer term look at the 10-year yield where we're wondering, are we starting to break out and set a series of higher highs after 40 years of setting lower highs and lower lows? Well, it looked like that might be happening as interest rates are going back up. But then since October, interest rates have been really coming down, and we're wondering, okay, maybe that's not a viable scenario right now. But over the past week, we did see interest rates going back up. Here's the 30-year yield, which is well off of the higher yield that it had been giving earlier in 2023. Then we compare the S&P 500 with the 10-year Treasury yield, showing how, for the most part, the S&P has been outperforming the rise in interest rates. But lately, as interest rates have been going up and stocks have been going down, that's why we're seeing this ratio going down. Here's the junk bond ETF, which continues to be in a pretty solid uptrend, even though it did fall back this past week. Then we do a ratio between junk bonds and government bonds. And this is kind of interesting what has been happening. Naturally, you would expect the junk bonds to outperform because they're more risky, but they also give you a higher yield. We saw that start to really come back down as interest rates were coming back down. However, with interest rates going back up to start the year, we're seeing this turn back up slightly, but junk bonds in a longer term look based on the trend continue to outperform government bonds or more conservative bonds. Here's the price chart of a 7 to 10-year bond ETF where we had become extreme positive and we're starting to come down with the RSI. We're still working off of a longer-term downtrend when you look at the moving average crossover. And the momentum had been positive for November and December. Now it's starting to roll over and look negative for the price of bonds. Then we look at yields. This is a daily chart going across all the different maturities where we had been seeing the yields coming down. Now, over the past week, they started to go back up. This is a weekly chart looking internationally where we had been coming down with US, UK, and German rates, but over the past week, they started to go back up. However, they're still continuing to decline in Japan. The MOVE index measures the volatility of bonds. The VIX measures the volatility of stocks. And then on the bottom, we have a correlation between the two. They were more neutral there for a while. Now we're starting to see this relationship get a little bit stronger. So bonds are gyrating around based on price. Stocks are probably gyrating around based on price. And what that usually means is that prices are going down. Then we look at a monthly chart of the longer-term bond ETF. This is the price of the 30-year, where it continues to be in a longer-term downtrend. Then on the bottom, we take a ratio of the long-term bond price and compare it with the CRB, showing that bonds continue to outperform in the long term. Then we look at different sectors and we compare them with the S&P 500. The materials are underperforming the S&P. Communication has been one of the stronger areas and continues to outperform, even though we fell underneath the 50-period moving average with this ratio. Energy bounced back up a little bit this past week, but has been underperforming the S&P. The financials are actually starting to resume an uptrend here. And we're also seeing some improvement here with this ratio as that area looks to be doing a bit better. The industrials continue to be in a downtrend, even though they bounced back up recently. Tech sector has been in a longer term uptrend, even though it's been seeing some recent weakness. Staples continue to be in a downtrend when compared to the S&P. Now, staples by themselves are in an uptrend, but they're still in a downtrend when you do a ratio to the S&P 500. We look at real estate, which has been bouncing back up. As interest rates were coming down, real estate likes that. So we saw some improvement here, but it's still in a longer term downtrend. We look at utilities, which also have a tendency to follow interest rates. They continue to be in a longer term downtrend. And here's a ratio between the S&P and utilities. And I show this in most daily videos. When this ratio is going up, typically the S&P is going up. When this ratio is going down, typically the S&P is going down. So we keep a close eye on this, but it's been really choppy lately. And we look at healthcare, which is more of a defensive area. It did see a little bit of buying this past week, but longer term, it's still in a downtrend. Here's another look at that same chart showing how it's been underperforming the S&P. Discretionary, which was pretty solid for a lot of 2023, and then over the summer it got weak. Then it started to look a little bit better. Now it's starting to show some more weakness recently. The staples sector, which you would think if we were in a really good economic environment, staples would be not seeing a lot of favor. They have been bouncing back up. And as we were rising since October, the staples sector has been going up too, which is kind of opposite of what usually happens. We usually see discretionary outperforming. And so that's a little bit of a concern, wondering, okay, how solid is this upward move that we've been seeing? And we look at the tech sector, which continues to be strong, even though it's seen some recent weakness. Semiconductors also very strong, but some recent weakness. The tech sector to the S&P 500 ratio, solid uptrend, recent weakness. That's kind of the theme here. Then we look at the energy sector and compare it with the tech sector, showing that energy is bouncing back up recently, but has still been underperforming the tech sector longer term. We look at growth, which are the buy low, sell high stocks, and compare them with more conservative government bonds, showing that growth, for the most part, is still outperforming bonds, but we're seeing this start to pull back, and that's a bit of a warning sign. The tech sector to the rise or fall in the 10-year yield shows that the tech sector is outperforming, even though it's been seeing some recent weakness. Here's an inverse of that same chart. The 10-year yield has been underperforming the rise in the tech sector, except it did bounce up in the previous week. Discretionary to staples, still in a longer term uptrend with discretionary outperforming, even though it has been pulling back compared to staples. Here's an inverse of that same chart where staples are underperforming discretionary, but seeing a recent bounce. Then we look at gold to the S&P 500, showing that gold is continuing to underperform. Even though gold's been doing well, it's not really breaking out. And with the S&P doing so well, that when you do this on a ratio basis, it shows that gold has been underperforming. And then gold is starting to outperform the dollar as the dollar was going down and stocks were going up and gold was going up. We started to break out above this red trend line, but recently we saw a bit of a bounce in the dollar and a bit of a decline in gold, so this ratio has been going down. High leverage loans continue to be in a really solid uptrend. And the NYSE composite, this is a broader measure of the market, continues to be in an uptrend. All stocks are also in an uptrend. Emerging markets, we're just starting to see a golden cross here. So this is showing some improvement. And the micro caps are also just starting to see a golden cross. Then we look at the home builders ETF, and we're not really seeing anything all that crazy right now. We look for divergences here, but they're just not happening at this point. Bitcoin continues to be in an uptrend. It actually got up into the 45,000 range, but has since pulled back slightly. And then we look internationally using the KST, which is our longer term oscillator. We're starting to see a turn back up in China. We're kind of rolling over now with the emerging markets. We're actually still declining in Europe. We're rolling over a bit in Japan, and we're also now starting to roll back over in the US. So we're getting a bit of a mixed picture here. We go back to InterMarket Analysis, and this is the start of 2023. So this is a little bit over a year old now. If you go back to that beginning date, and as we go further into 2024, I'll replace this with another chart. But stocks are still performing the best, followed by gold, then the dollar, and then the price of bonds, where the price of oil continues to be negative. And then we look at some correlations. We look at the S&P 500 and compare it to the dollar, and they're having a really strong tendency to go in opposite directions. So if the dollar is down, that typically gives support to stocks. If the dollar is up, that may put some pressure on stocks. We look at the S&P 500 to oil correlation, where that's pretty much neutral right now. It's not really having an impact. And we look at the S&P 500 to the 10-year yield, and that is having a pretty strong tendency to go in opposite directions. So if interest rates are down, stocks are probably up, at least for right now. If interest rates are up, stocks are probably down. Then we look at the tech sector to the 10-year yield. That's also telling us the same thing, that they're going in opposite directions. Then we look at a shorter term yield, the 2-year yield. They're also having a strong tendency to go in opposite directions. Then we look at some long-term secular and cyclical trend studies. Secular just means decades, where cyclical could mean years. Where when we look at the NYSE composite monthly chart, we are still positive. We're above this red line, which is a moving average. And when we look at the Copic curve, which is another momentum oscillator, it continues to advance. Here's a daily chart of the NYSE showing the NYSE record high percent index. That's continuing to go up. And so on a daily basis and a monthly basis, the NYSE is still positive. We look at a monthly chart of the S&P 500. We're above the moving average, and we're continuing to go up with the percentage price oscillator, another momentum oscillator. And then we look at a ratio of the S&P 500 to the CRB index, showing that stocks continue to outperform commodities. And then we look at the S&P 500 and look at another global index on a monthly basis. The S&P is still outperforming. We're starting to see a bit of a cross here with the KST, and this is a long-term oscillator on a long-term chart. So we don't get an awful lot of signals with this chart. Then at the very end of this video, I take all the things that are positive and I make a list, then all the things that are negative. My definition of positive is when the 50-period simple moving average is above the 200-day simple moving average. I know the weakness of moving averages and that they can lag, and sometimes it's not real indicative of what's happening. But this is just to give us a general idea of the longer-term trend. So we have the growth indexes and ETFs, which are now positive, as well as the value indexes. The dollar is still up, and the British pound and the euro compared to the dollar. So that's kind of interesting. We're seeing them all in uptrends. Gold is in an uptrend. The mega caps, the big software companies, just barely hanging on to an uptrend. The FANG index, as well as ARK, the Dow Jones Composite Average, is in an uptrend. And then we look at total bonds, high yield bonds, investment grade bonds, corporate bonds, as well as junk bonds. And the tech sector, as well as the semiconductors, are in uptrends. High leverage loans, the Dow, the NYSE composite, the NASDAQ and NASDAQ 100, mid caps and small caps just recently generated a golden cross. Now that we're seeing a bit of a pullback. All stocks, which looks at U.S. stocks as well as internationally. Emerging markets, that's a new addition to the list. And then the Bitcoin index continues to be in an uptrend. Negative is when the 50-period simple moving average is below the 200-period simple moving average. The CRB index, we did see a recent death cross there. Silver is still in a downtrend. Copper, it's really bouncing around, but still in a longer-term downtrend. The Japanese yen, when compared to the US dollar. The low volatility ETF showing a little bit of improvement, but still in a downtrend. The staples, which could be getting ready to give us a golden cross here pretty soon. World bonds are showing some improvement, but not enough yet to go into an uptrend. The micro caps are showing improvement as well, but some recent weakness. So there, and this just kind of ends right here. So thank you. I hope you found this helpful. Please feel free to check out the daily videos that I post, as well as the weekly video. After this, I'll be preparing what I call the deep dive video, where I go through all the daily charts that I really didn't talk about in any of the videos to see if we can get any insight from that. Have a great weekend, and I will talk to you in the next video.